Hello and welcome. My name's Andy Crook and I'm your host for tonight's training topic all about more turnover or more profit. My mission is to help garage owners become more successful in business. How do I do that? I try and deliver a training topic of around about 15-20 minutes in length every week on a subject on one of the 5 pillars of business as I see it. This week we're in the financial pillar and we're talking about whether or not a business should focus on more turnover or more profit, which seems like a silly question, but it's not once we start to delve into the detail. So join me for the next 10-15 minutes for a discussion all about turnover and profit. So the decision to focus on increasing turnover, sometimes called revenue, or profits, depends on the specific goals and the stage the business finds itself at. Both are important metrics, but the emphasis may shift based on various factors. And we're going to look at those factors in this training topic. And how we're going to do that, we're going to start by telling us a short story about 2 garage owners, Mike and Tony, who were engaged in a spirited discussion over steaming cups of coffee in the break room. In the background you can hear the clang of tools and the rev of engines as Mike, the owner of a relatively new garage, leaned forward, his eyes alight with determination. "For me, it's all about boosting our revenue, sales and income right now," he declared. "My business is still in infancy and I've been laser focused on attracting new customers, increasing our service volume and expanding our reach." Across the table, Tony, a veteran of the industry with a well-established but smaller workshop, nodded knowingly. "I can relate to that mindset," he said. "In the early days when you're trying to make a name for yourself and build a loyal customer base, turnover is crucial. It's the lifeblood that keeps your garage afloat and fuels that growth." Mike's face lit up with recognition. "Exactly. Every time we launch a new marketing campaign and when we hired a new technician, the surging revenue, transaction and receipts was a tangible measure of our progress. It was like a shot of adrenaline, giving us the confidence to dream bigger and explore new opportunities." Tony smiled, recalling the early days of his own venture. "I remember that exhilarating feeling," he mused. "But as your business matures and establishes itself, the focus tends to shift more towards profitability, maximizing your margins, streamlining your operations and ensuring that every pound spent translates into an healthy return." "Profits, earnings and gains," Mike repeated, nodding slowly. "I can see how that would become increasingly important as you solidify your position in the market." "Precisely," Tony affirmed. "Don't get me wrong, turnover is still essential, but it's about striking the right balance. At a certain point, you need to start leveraging your experience and efficiency to boost your bottom line. That's when profitability, net income and yields become the driving force behind your decision making." Mike leaned back in his chair, contemplating Tony's words. "It's fascinating to see how the priorities evolve as a business moves from infancy into adolescence and finally into maturity," he mused. "Right now, I'm focused on capturing as much of the market as possible, expanding our service offerings and attracting more customers. But down the line, I can envisage a shift towards maximizing profits, surpluses and dividends." Joni chuckled. "Trust me, it's a delicate dance, constantly balancing growth and profitability, seizing opportunities while maintaining fiscal discipline. But that's the beauty of running a successful garage. You're consistently adapting to the ever-changing landscape and making strategic decisions that will keep your business thriving." As their conversation wound down, Mike and Tony felt a renewed sense of clarity and purpose. They understood that the pursuit of turnover and profitability was not an either-or proposition, but rather a dynamic interplay that would ebb and flow through time and the various stages of growth, the final objectives of the business. And with that insight, they felt better equipped to navigate the challenges and seize the opportunities that lay ahead in the ever-evolving world of vehicle repair. So, as you can see through the little story there, that it's not really a decision between turnover and profit. It's a decision when to pursue more turnover and when to pursue more profit. So the first thing probably to to make clear is, what is the difference between turnover and profit? So turnover, the amount of sales in a cash value effectively, reflects the sale of the business activity. Profit, the surplus after all expenses, reflects the company's financial health. Both turnover and profit have an impact on cash flow, but in different ways. Higher turnover increases potential cash flows, but actual cash flow will depend on how quickly receivables are collected and how efficiently the business manages its payables and inventories. Profits contribute to cash flow, but can be affected by significant amounts of unpaid receivables or substantial capital investments. So you can see that effective cash flow management requires attention to both turnover and profit, as well as the timing of cash movements related to these metrics. We've said it before in various training topics that cash flow is the lifeblood of any business. Without cash flow, a business will quickly stop trading. So, and you can see how more turnover, in effect more sales, can increase the potential for cash flow, but it depends on other things, and that's where the profitability comes in. So the question we really want to focus on in this training topic is, when should a business look for more turnover, and when should a business seek more profit? So let's start with more turnover, and let's start with a business in infancy. And if you don't know what a business in infancy is, there's a training topic on this. It's called the 3 stages of business. If you don't know or understand these terms, it's well worth seeking that out and having a listen. But basically, a business in infancy, the easiest way to sum that up is a business that will stop trading or operating immediately if you take the business owner out of it. That's the easiest way to explain a business in infancy. And it's got nothing to do with how long a business has been trading, although that has a bearing. It's more to do with how much the business relies on the owner. That's how I describe a business in infancy. So often a business in infancy, and in the initial stages of that business, they will often prioritize increasing sales and gaining market share so that they can have a higher turnover to help generate more cash flow, fund their operations, and start to drive growth. So a business in infancy is more likely to look for more turnover than focus on more profit. Another time when a business could look for more turnover, and this doesn't got anything really to do with the stages of the business, but it's when you're looking for economies of scale. So some businesses can benefit from economies of scale, where higher sales volumes lead to less or lower unit costs. Increasing turnover allows them to spread their fixed cost over more unit sales, improving profitability in the long run. But you can't get that profitability until you've got more sales, which is more turnover. So you can see that what you're doing here is per unit of whatever that is. So if we took, for example, MOTs, the more MOTs you do, the less the unit sale cost. The cost of doing business per sale reduces because you've got more of them to share the cost over. So if you've just invested, if you like, in an MOT bay, you probably want to look for more and more MOT sales to begin with, which will drive down the cost of each MOT, which will then reduce or increase profitability by reducing the unit cost. And the third reason why you should look for more turnover if you're in this position is market dominance. In highly competitive markets, a higher market share and higher turnover can give a business more leverage in negotiations with suppliers and customers, as well as creating barriers to entry for competitors. So if you're dominating a market for a particular service in your area, you can then start to use that as leverage in negotiations, as well as making it more difficult for another business to come in and if you like, impinge on that market dominance. So there are 3 reasons why a business should look for more turnover. As you can see, when it comes to economies of scale, that business may not be in infancy. that business may be in a different stage. And with market dominance. Market dominance in highly competitive markets is more likely to be a business leaning towards maturity. So you can see that although a business in infancy tends to be when you're looking for more turnover, it isn't always the case. And it depends on what your strategy is, the end goal of the business, as to whether or not you're looking for more turnover or when you should seek more profit. So that brings us nicely on to when should you seek more profit? Well, a business in maturity, and we define a business in maturity very simply as one that will continue working when the owner of the business isn't there. So you take the owner or the owners away and the business continues on as if nothing's happened. That's a business in maturity. That's the easy way to define it for the purposes of this training topic. So once you've reached maturity, the focus may shift towards improving profitability. This involves optimizing operations, reducing costs, and increasing efficiency. That's what a business in maturity is doing. Now, a business in adolescence might be on that same road, but probably doesn't have enough experience, is probably the right way, enough trading history to work out how to optimize operations, how to reduce costs, and how to increase efficiency just yet. It might be on the horizon, it might be something that they're working towards, but a business in maturity, this is what they should be focusing on. The next time when a business should seek more profit is when there's limited growth potential, or if you don't want to grow. They're two different situations. You may not want your business to grow, or you may be unable to expand. Let's just say the site you're on, you don't want multiple sites, and what you want is on site, but you can't expand, you can't increase the number of bays, you can't increase the number of ramps. So the only option you would have to make that business bigger would be to go multi-site, but you don't want to do that. So you've got limited growth potential. And when you're in this position, it makes sense to concentrate on maximizing profit from the existing sales base. So you may increase sales and therefore turnover or revenue slightly by getting better at marketing, but it's going to come from the efficiency side of things, which will increase profit because you might be able to do slightly more work with the same resources. And that's another reason why you might seek more profit. And finally, cash flow management. Now, we talk about how turnover and profit can influence cash flow. But business with strong cash flows may prioritize profitability to fund expansion, research and development, or other strategic initiatives because you're not going to rely on external financing. Now, there are times when borrowing money is good, and there are times when borrowing money is bad. And it depends on the strategic aims of that business, whether or not those decisions can be made. But if you do have quite good cash flow, and you've got quite good cash flow management, you've got positive cash flow in the business every month, you might look at seeking to increase your profitability based on that cash flow so that you can fund, if you wanted, expansion or R&D or whatever the strategic initiative is that you're looking at without having to borrow too much money, if that's your aim. Now, there are times when borrowing money is good, and there are times when borrowing money is bad. And you need to speak to your accountant about that and the best and the most efficient way to use finance within your business. I'm not qualified to give that advice. So, what we should be working out now through these conversations, it's easy to see that these goals of more turnover or more profit are not mutually exclusive, and businesses often need to strike a balance between growth and profitability based on their specific circumstances and their long-term objectives. And probably the biggest objective to look at is what you're going to do when your association with the business ends, if you're the business owner. Are you going to shut it, sell it, or are you going to issue shares? That's the sort of the three ends to a business. So a business in the adolescent stage, and how we define a business in adolescence very simply is a business where if you take the owner out of the equation, will slowly grind to a halt. It won't stop immediately like in infancy. It won't carry on forever like immaturity. It gradually grinds to a halt. That's a business in adolescence. That's the easy way to think of it. And a business in the adolescent stage is one that's prone to switching between prioritizing turnover and then profit. So it might prioritize turnover, and this is the classic example of this: more staff. So you have more staff because you can do more work, sell more things, get more revenue, and then you think, oh, hang on, we need to improve efficiency to get more from the return on investment of those staff. And it's often common when a business employs their first member of front of house staff or additional front of house staff. The cost of doing business now has increased, but without careful management, there may not be an increase in turnover. So you've actually affected profitability. So I'll say that again. So you've added to your non-productive staff, which means you haven't done anything to increase revenue, which means your profitability has gone down. So you can see you're chasing more revenue. You want the technicians to be more efficient, and you do that by employing front of house staff, but actually initially there'll be a dip in profitability. It's exactly the same when you hire additional techs. More hands make more work for the business owner or the front of house staff, and as a result you'll often find efficiency drops, and the increased turnover results in similar or slightly less profits than before. And this is what I call the loop of doom. And what happens here is the business owner quickly realizes that staff means problems. I'll get rid of my staff, I'll do it all myself, and you get back to square one. And then you get fed up with that, then you take on more staff, and then staff means problems. You want to do it all, and on it goes. You're probably familiar with it. That's a business in adolescence, and in adolescence is a business when the business is most vulnerable to something going wrong. And it's a really, really, really important time to make sure you're doing your strategic reviews and making the adjustments to turnover and profitability when necessary as the business evolves. And that's why I like my planning idea of a 10-year plan, and you look at it every 3 years in some detail, and you set three-year goals with a spare year to adjust. So hopefully that's given you something to think about when you're thinking about turnover or profit, and which one you should be focusing on in your business. And it depends on a number of things, one of them being the stage of business you're at, the aims of the business and the specific goals, and the end of the business or the end of the association of the current owners with that business. They will all have an effect on whether or not you're going to focus on turnover or profit. If I've made you think a little bit about how you run your business, then I've done your job. Please join me again next time when we cover another of the 5 pillars of business in one of the training topics. Thank you. Thanks for listening. Bye-bye.